We had this big discussion yesterday while nobody was in the office, although you and I were, about there's been several movies this year, more than usual, that have gone over the 3 hour mark, which is surprising. Like I think it said like 8 movies out of the last 12 that created over 3 hours, like 8 of them came in the last year. So they were saying that movie theaters have started to add in breaks during 3 hour long movies because the customers want the breaks to either pee or to smoke or whatever they need to do for that 15 minutes. The movie studios, though, have basically said you cannot do this anymore. We do not allow you to have breaks in movies, because when we give you this movie to show, it has to be shown in the exact way that we show it to you with no breaks.
What I'm going to do, I'm going to slip in the shoes of Tom Cruise. And I'm going to think to myself, what would Tom Cruise want? And we all know Tom Cruise is a purist. No breaks, Brett. No breaks.
Okay, but now there's lots of reasons to have a break, right? As you get older,
I'm not saying there's
Marcos,
no reason. I took a side, man, and I'm leaning into it. Tom Cruise saved movies.
some people need a break, but a lot of people don't need the break, but it'd be nice to have. I can go get some popcorn. I don't have to not, avoid drinking during the first half of the movie because I might have to go pee the second half or run out and miss something. What if I was confused by a part? What if I wanted to smoke or my lights were on my car? Like lots of reasons you can need a break.
You smoke?
No, but people do.
Smoking now just because there's breaks. You see? And now you just hurt your life expectancy. Now you smoke.
Saying this is bad for society.
You said that. You said that. You said that.
We'll also have less people with urinary infections because they're not holding it all moving.
Yeah, touche. Less UTIs. So you're saying less UTIs. Okay. Okay. I have a daughter. I get it.
I think it happens to men too.
I've never had a UTI. I've never passed a kidney stone either. Have you?
No, it looks awful though.
Yeah. For the 60th episode, you should pass a kidney stone.
I am not agreeing to that.
Welcome to episode 46 of Talk Your Chart with Marcos Segura and Brett Horowitz. Brett, how are you?
Great, Marcos. Today is November 14th. Let's let people know that. And we got some really key data this morning that was fantastic.
Oh, I don't know what you're talking about. Just kidding. It's my first chart. CPI, my friend, everyone was waiting for it on bated breath. Nothing else matters other than the Fed, which means nothing else matters other than CPI. And the markets were happy. How happy were markets, BH? Well, I'm looking at the Russell 2000 up 5% right now. That's a little weird. So what do we get? We got a core CPI reading of 3.2, and removing food and energy, you get a cool little 4. But I guess forget about the 4 for now. We'll just talk core. We got 3.2, which was under estimates. That core was, wow, year over year on 4.1 through September. So yeah, the trend is our friend, and the trend is that CPI has been under control. I guess here's what I'll tell you. If you're looking at this and thinking, okay, perfect, the Fed can cut rates now, not a chance. I still think they're going to take the hawkish pause stance and tell folks that they will wait and see until inflation is negative or something. They'll just be saying wait and see.
Yeah, they have to do that, I think. But I agree with you that I think if I'm the Fed right now, I'm sort of patting my back, because I think I did a pretty good job of setting expectations that we keep them high, and that there's going to be no chance in the short term that they're going to lower them. And so that keeps people from trying to think that inflation is going to bounce back up and they're going to have to get into a problem going forward. So I agree with you. Stay for higher and maybe cut sometime next year, but keep saying if the data doesn't get better, we're going to keep our foot potentially on the gas.
Okay. I think this is not the first time I'm going to say this. I have never been a fan of the hard or soft landing thing. I think it's just a constant state of no landing, whether we are in good or bad times. But whatever. I think even on this little show of ours, we spoke to that one listener out there and said, Jerome Powell, he tightened too fast, too much too fast. Were we wrong? Are we the ones with egg on our face?
No, it's been perfect. This is exactly, we've talked about this. It's exactly what we wanted to happen. You got good GDP numbers, good retail sales numbers, good jobs numbers.
You
Low
said he did too
inflation coming
much.
down.
You said he broke it. You said he did too much.
I don't think he did too much.
Well, it's easy to say now, isn't it? When inflation's cooling as nicely as it is.
We said stop. I think they've stopped. I don't think they're going to do any more ever again for the next next year or two, and they've accomplished their job.
Yeah, we'll see what happens. Unemployment and market is baking in or pressing in cuts about summertime next year. We'll see what happens. All right, inflation's good.
I heard a great quote on the radio the other day. It said, "Comparison is the thief of joy." Apparently, it was attributed to, I think, Teddy Roosevelt.
I was gonna go Mark Twain. Okay.
And it had to do with someone who finishes in second place in the Olympics apparently is less happy than someone who finishes in third place in the Olympics,
Of course.
because second place closer to first and third is closer to not getting anything. And so the person in second says, "Man, I almost came in first," because the person in third said, "Almost got nothing."
What's the formula for happiness, Brad?
Joy plus money divided by love. I don't know.
You're so close. Let me help. Happiness equals reality minus expectations.
Okay.
Second place had too high expectations.
Well, so here we have a chart showing the S&P 500 going back to 1996. And I feel like a lot of clients look at this chart, and we've heard them in the last few years, and our clients have said, we haven't made any money, right? We were at this high point back in early 2022, late 2021. We're still not back to that high point we're still not back to the high point yet. Like, man, I haven't made any money. I don't feel that good. I just want to put it in perspective as to, like, you're comparing yourself to the high watermark ever made in the stock market. Let's compare where we were back in 1996 or 2000 or 2007, or look at that ride from 2008 all the way up to 2021, 22. Like, it was enormous. And so I think whether clients compare to a high watermark or to their friends, whether people think that they should be at a different point or want to make more, like, it's been a great ride we've been on the last 15, 20 years.
Good for you. I like that. That was full circle. I appreciate how you did that. Started with a quote and ended there. This is, I think, I don't know if I have the chart, but we've shown it before. Everyone got spoiled because in 2021, there was 33 all-time highs. And in 2020, there was 33. And in 2019, there was 36. And so we just got drunk. We were drunken sailors thinking all-time high just happened every single time. From 2008, Brett, to 2012, guess how many all-time highs there were?
100.
0. It's also, isn't that ridiculous? From 2008 to 2012, no all-time highs hitting the market. From 2005 to 2012, 2005 to 2012, 9, all in 2007, and then eviscerated. So yeah, market's not always making new all-time highs, and you can still be making progress. Good message. I like it.
So just to add on to that, one more chart here, which is similar to charts that you've shown in the past, talking about net worth and balance sheets of the average person. I think there's a chart here basically showing net worth made up of your financial assets plus your real estate minus your debt. And I know the media loves to talk about how debt is at a high point. It's not been this high for a number of years. Yeah, that purple is creeping up a little bit. But basically net worth, because the financial assets have gone up so much, and real estate, even with a little drop the last couple of years. Net worth now stands at $154 trillion, almost double what it was 10 years ago.
Beautiful. Life is good. Okay.
So again, we want to compare versus where we could have been or where somebody else is, but, like, let's appreciate how far we've come and how healthy balance sheets look as we've done, chart to chart, episode after episode.
Yeah. And let's also remember that servicing that debt has never been more affordable because you probably locked in a real low rate for whatever it was.
Exactly.
Okay. So we have the same chart, but on different asset classes. Do you want to go stocks or bonds first?
Let's go stocks. We already talked about the S&P.
Okay, fine. We'll rock right into that. So we've shown this chart 100 times also, I think. I'm showing it again. Why? Because this year's been great. We're up 15%, not counting today. So we'll be just off all-time highs while totally doing the whole full circle thing. Well, actually, BH will be what, like 1-2% off all-time highs after today if it closed right now?
4,800 on the S&P was the highest. So if we're at 45, we're probably still another 5% off.
Okay. Yeah, no, you're right. Because I'm getting teased by the Russell 2000 being up 5%. Okay, so what I show is because this year so far we've had a good year. Is it as good as we want it to be? Of course not, because we always want more. But we're up 15% so far. Again, not including today. But we had a terrible July through September, or yeah, early October, excuse me. And July through September. Let me see if I can pull it up here. So July 31st to October 27th, that was kind of the most recent peak to the trough. We lost just shy of 10%. And since then, we've gained just shy of 8%. That 10% drop, from my perspective, BH, and you could try to tell me the headline that caused that to happen. I don't care. I'm going to disagree with you, and I'm going to tell you that that was the water cycle. That's just because markets have to take a breath, because on average they fall 14% any given year. So you can point to whatever headline you want. I think that 10% pullback was healthy. Probably what ended up happening is folks with not enough proper temperament in them, so to speak, gave up shares, and someone got them at a better price than they had them.
So I want to tell a story here that's sort of off topic a little bit, but we'll get back to topic.
We'll allow it.
We know that all these weight loss drugs, Ozempic and Wegovy and all those other things, if I'm pronouncing that right, have been huge hits. They've done a lot of good things. Apparently, since those drugs have come out, though, a number of stocks have taken on the chin. Coca-Cola, Heinz, you sell cupcakes, you sell brownies, whatever, all those things. Even medical manufacturers are saying people are going to use my things less because people are going to be healthier. So a lot of companies have really taken on the chin thinking this is going to change the entire world, right? Yeah. Lots of angst. I read an article comparing this to what happens back in the 90s when you had the Atkins diet. Actually, it was the early 2000s. Atkins diet came out and everyone said, oh my gosh, no one's going to be eating carbs anymore. So all the fast food restaurants are going to go out of business. And I was reading that after that happened in early 2003, McDonald's shares of stock fell 30% and were trading at only $30 a share at that time. They're now trading at $260 per share. So where I take this is, I think we tend to look at everything that's happening and saying, what could go wrong? And you sort of sell first before worrying about, thinking it through and, hey, we'll get through this just like we've gotten through everything else in the past.
Yeah.
And the fact that we were down and there's all these things to worry about, whether it's government, whether it's not having a speaker of the house, whether it's the wars, whether it's all these things, like, yeah, those things happen, but we get through them. And eventually prices will keep going up and up and up. And so we weren't worried about the drop, but that's what you see happens, I think, in the markets a lot.
Yeah. So Brett's long Wonka bars, we got that. And yeah, as long as they didn't go out of business, that's fine. But yeah, I doubt McDonald's is going anywhere. So fair point. People, it's like shoot first, ask questions later. That's kind of what ends up happening. So yeah, we had a 10% correction this year. Consider it healthy.
So let's also talk about the bonds, because this is getting everyone's up in arms about what's happening.
It is a crazy chart, man. It is a crazy chart if you look at it.
47 years now of data on bonds, 42 positive years. And if the year were to end today, we'd have the first 2 years back to back in the last 47 years. Now, Marcus, I know you remember the last 2 years that the bond market was negative, but I'm going to tell it to the people so that you don't have to guess. 58, 59, because that's what you're probably going to say, was the last 2 years that happened.
I know.
So it has been
tattooed on my wrist.
It has been a horrible year for bonds last year. This year has not made it up, but don't bail on bonds, because look, your chances of having this continue is infinitesimally small, right? Your chances of getting these big returns on the flip side, you can see the last time bonds had negative returns, what happened in the years following, they were fantastic. That's what we try to tell our clients and tell people is don't look at the last few years and think like this is going to continue. Rates have stopped going up. They're not going to go up. They're going to go down. You're going to get a good return on your bonds going forward.
Yeah, dude. The 10-year is now sitting at 4.4, down 12 basis points this week and down 26 basis points this month.
Oof. And what does that mean for clients? It means when interest rates stabilize, you finally get the yield on your bonds. If rates go down like they have this week, you get a pop from having the bonds. So you were in it with the losses, stay in it to achieve the gains going forward.
No, the math, yeah, the math is undeniable. Incredible. That is an awesome chart, though. You got the first, it could be 3 years in a row. Incredible. We'll see. CPI reading is helpful to this.
What's next? You want to talk about growth versus value?
Yeah, and then Japan. Why are you talking about Japan? They got bad demographics, man.
So let's talk about Japan first, because that sort of plays into the inflation thing.
Okay, fine.
Something happened in the land of sushi and the land of Godzilla that hasn't happened in decades.
Okay,
Probably
I love all those things.
Since you were alive, it hasn't happened. What happened? Japan actually has seen some inflation. Okay. So if we go back into history, back in the 1980s, just like everybody else, they got caught up in the gasoline shortage. They had super high inflation. Actually, it hit 20%. And then the 90s, it's sort of stabilized. Then you had the real estate market dropped. The stock market dropped. You had the Asian financial crisis. And since the 1990s and 2000s onward, they have been in a deflationary environment, or if they've had inflation, it's been very, very low inflation. We all think that's great. We all want low inflation, right? This last year of inflation high has been horrible, but deflation is worse than high inflation because people expect prices to go down. They don't get wage increases. They don't want to spend because prices keep going down. It sort of becomes secular. The mood is sour, and the government really can't do much about it. In fact, in Japan, they actually put in negative interest rates. That didn't help. And it didn't take until finally COVID, the supply side chain, and some cash that the government handed out that people are finally seeing inflation. So we do want inflation. Inflation is good to some extent because deflation is far worse. And last thing I'll point out, their stock market hit a new high in 1979 and has not recovered since. That is what deflation will do.
Yeah, that's the chilling stat. They've annualized, so EWJ is the ETF that tracks the Japanese market. Over the last 10 years, annualized at 2.5%, while the US stock market is annualized at 9.7%. It's a tough decade.
Tough 40 years.
Tough decade. Yeah, okay. So what's the take here? Japan. So this is just showing us that deflation is not your friend either.
No. I know people like to complain about the inflation, but I'd rather have an inflation, maybe a transitory inflation for 1 year than have deflation for 40 years.
I still think transitory was right. They just got upset too soon.
Yeah.
Everything's transitory.
For sure.
Ha. Last chart, and this one's just fun to look at. Why'd I run into it? Brett, because you make me smile. And this chart is doing just that, it's smiling at everybody, at the viewer that's looking on YouTube instead of listening on an AirPod. What is this? So it's a ratio. It takes as the numerator the total return of the NASDAQ, and it puts as its denominator the total return of the smallest companies in the US stock market. So it basically shows you how large the NASDAQ is relative to the smallest companies in the US. It covers from 2000 to now. And as we can see, there's some similarities between early 2000s and right now. And what's it tell you? This just means diversify your portfolio. If all you own is the NASDAQ, if all you own is the Magnificent Seven, or whatever new cute little term is for the largest 8 companies in the US, maybe you consider holding something that isn't those companies.
So it doesn't tell you that NASDAQ is going to fall 80% like it did in 2000, 2002, and then take 15 years to come back. I hope you're not saying that.
You said that, not me. I didn't say that. I didn't say that. All I'm saying is maybe you sneak a little small cap stuff into your portfolio.
Well, I'm saying it feels like 2000, but just everything that went wrong in 2000 is not going to happen to the NASDAQ.
Look, smiling faces don't lie, Brett. This thing is perfect. This thing is called Talk Your Chart. That is a talkable chart.
That is a nice chart. And what we do know is different in 2000 than today is the companies in the NASDAQ are making a lot of money.
They are. Oh, and I'm sorry, let me a little attribution. Charlie Bolello. That's the gentleman who I stole this chart from. He showed it to me. I show it to you.
Well, I like happy charts.
Yeah, it's good. It tells a story, my friend.
If this does become similar to 2000, it'll become a frown very quickly. That smile will be upside down very soon.
It would. Maybe next episode we'll find the opposite of this, a frowning chart. I guess I just could have put the Russell 2000 as the numerator here. Okay, maybe I won't.
Okay, good one.
Until next time, my friend. 50,
Adios.
episode 50 around the corner.
See ya.